Hi, everybody. Welcome back. This is John Nia, one of the partners at Trowbridge Nia LLP, and today I'm going to be talking about the top 4 provisions of the operating agreement you should be aware of. But before I get into that, although I am an attorney, I am not your attorney, so please do not take any of this as legal advice. This is all for education purposes only. If you want legal advice, feel free to give us a call. You go to our website, TNLLP.com. You can schedule a free consultation with any of the attorneys at our firm, and you could hire us as your attorney, and we will give you all the legal advice you want at a flat fee, too. So you don't have to worry about billable hours with us. We charge a flat fee, and you get unlimited calls, unlimited emails, unlimited legal advice with whichever attorney you choose to work with. Anyways, back to the question at hand today. What are the top 4 provisions of the operating agreement you should be aware of? So for those that don't know, the operating agreement is the legally binding contract that governs an LLC, a limited liability company. It sets out all the rules that all the members have to follow. It sets out all the restrictions, everything you need to know about how an LLC is run, is governed. It's all in the operating agreement. But today I'm just going to be focusing on 4 provisions that I think are the most important, the ones that you should be looking out for if you're, setting up your own LLC, or maybe you're an investor looking to invest into an LLC and buy membership interest in an LLC. What are the provisions that you should look at first? So number 1, management authority and management rights. So every operating agreement is going to lay out who has management authority. You can either set up an LLC as manager managed or member managed. If it's manager managed, the LLC is going to, or the operating agreement is going to say a certain person or certain people are the managers of the LLC. These people have been delegated the authority to make all of the decisions, to control the LLC, basically, on behalf of everyone else. It's more kind of similar to a GPLP structure, so limited partnership. You have limited partners that do not have any authority to make decisions, and then you have a general partner who has all the authority to make all the decisions on behalf of the LLC. If an LLC is set up as manager managed, the manager has all the authority, and all the members, the non-managing members, do not have any authority to make decisions. So that's a very, very important provision of the operating agreement that you need to read, because that's going to dictate who has control over the LLC. If the LLC is member managed, then typically what the operating agreement says is all of the members have authority to run the company. So you can imagine if an LLC has, 2 or 3 members, that's probably doable, right? Everyone can come together and agree on decisions. But if you're setting up an LLC and there's, 20, 30, hundreds of members and it's member managed, you're probably going to have some issues with making decisions. How are you going to come to consensus when, 20, 30, 40, 100 people have the right to make decisions? So it's very, very important that you, draft this provision properly. You hire an attorney to draft this for you, and you think about these questions when you're getting ready to set up your LLC. How do you want to structure it? Who do you want to give, that management authority to? And if you're an investor in one of these, LLCs, it's very important you pay attention to this provision, because it's going to dictate who has control over the company that you're investing in. So that's provision number 1, management rights, management authority. Second provision that's very, very important that you should pay attention to is voting rights. So typically in an LLC, it's going to lay out who has the right to vote and on what, right? So in most of our LLCs that we set up for our clients, we usually put different tiers, different thresholds for making um, different, sorry, I guess voting on certain things, right? So certain things will require a unanimous vote, and examples of things that require a unanimous vote are things like substantively amending the operating agreement, dissolving the company, selling all of the company's assets, things like that, where the company would basically end or cease to function. That typically requires everyone to agree on that decision. So we give everyone, um, the right to vote on that. Other things you might want to set like a 75% threshold or a supermajority with 66% or a simple majority, right? So things like whether or not to remove the manager for cause, whether or not to sell any specific property that the company owns, whether to sell new interests in the company. And this is going to kind of foreshadow a little bit about what I'm talking about later, but things like a capital call, right? Is a vote required to do a capital call? Uh, but the point that I want to make to everyone watching this is it's very, very important that you have this section of the operating agreement clearly laid out, right? What are things that members can vote on, and what are the thresholds that they need to or that they need to meet to approve those votes? So again, very, very important that you hire an attorney and you talk with your attorney when you're setting up the LLC. What do you want to set these thresholds at? What do you want to give your members a right to vote on? Or maybe you don't want to give your members certain things the right to vote on, right? Maybe you want to be able to control whether or not you could sell the property. You don't want your investors to have a say in that, to have a vote on that. Well, talk to your attorney about that and make sure that that's specifically laid out in this section of the operating agreement where it talks about voting rights. So, first section, management authority. Second section, voting rights. Third section, I mentioned already, capital calls, right? This is a very, very important provision that especially investors want to focus on and talk about and learn about. You know, what are capital calls? First of all, so if you've ever invested in an LLC, there's going to be a provision about whether or not you are required to contribute additional capital to the company. And that is what a capital call is, right? So say the company is in trouble, typically is what happens, right? The company is running and um, the company is having trouble meeting its, operational expenses. Maybe the property isn't, cash flowing as much as you planned for. Maybe you got some sort of bridge loan and now the interest rate has gone crazy through the roof and you can't afford, loan payments anymore. Whatever the case may be, there's some trouble that the company is going through. What are your options as far as getting some injection of new capital into the company to survive, to keep the company operating and running? Well, one option is by asking your investors, asking your members to contribute additional capital into the company or doing a capital call. So very, very important if you're, the manager of the company, what are your rights as far as do you need to take a vote to do a capital call, or can you, just do a capital call without asking your members? And then if you're an investor in one of these companies, it's very, very important uh, whether you have to contribute capital, whether it's required or whether it's permissive, right? It's only um, it's only not required, but you're asked to contribute. You don't have to contribute. Maybe there's no penalty. Sometimes there is a penalty, right? Um, you know, Examples of a potential penalty that companies can inflict on members who do not contribute additional capital are things like removing their voting rights, removing their rights to future distributions, um, charging them interest. Well, typically there's some sort of dilution provision, right? So, if there's nothing, if the language is silent on all of this, then the only penalty effectively that can happen to an investor who doesn't contribute is their interest will be diluted because there's new money coming into the deal. You're not putting additional capital into the deal, so your percentage share of the company is going to go down. It's going to be diluted. Well, one potential penalty is adding some sort of additional dilution penalty to investors who don't contribute. But again, at the end of the day, very, very important if you're, an operator or sponsor, drafting your operating agreement to make sure that this provision specifically lays out your plans, and gives you some, wiggle room as far as if you run into trouble operating your company in the future, you have to be able to have some sort of, process of getting new capital into the deal to save your company. And if you're an investor looking at these provisions, you want to make sure that you're aware of what can possibly happen if the company faces some trouble in the future, right? Are you going to be required to contribute additional capital? Are you going to be penalized heavily if you, don't do that? So again, very, very important that you pay attention to that provision. So we talked about management authority, talked about voting rights, talked about capital calls. The last provision that I want to talk about is liquidity. This is something that everyone needs to consider when you're investing into an LLC. You know, how do you get your money out of the deal if you need to, right? That's what liquidity is. Can you sell your interest? Is that even possible? Well, the operating agreement is going to control that. There's going to be a specific provision that talks about how you can sell your interests to someone else or maybe to someone in the company. We like to put some sort of provision where there's a right of first refusal because, at the end of the day, our clients are the ones that are running these companies. They're the manager typically, and they need to be in control of who comes into the company, right? You don't want to allow your investors to just sell their interest to anybody because they could potentially sell their interest to someone that you may not agree with, who's going to possibly cause trouble and issues for you. So you want to have some control over that to make sure that everyone coming into the company is someone that you want. So there's typically some sort of right of first refusal provision where, if an investor wants to sell their interest to a third party, they have to first offer the same interests and terms to, you as the manager, and then it goes down this list of, who can buy that interest. So individual members of the company, um, a group of members can combine their interests together and purchase the interest. But it has to go down this list, right? And if no one wants to buy that interest on those terms, then the investor can go out and sell their interest to the third party. But what we also do for our clients is if that happens, then the manager still has authority to say or grant this new person the right to become a full member of the company. So typically what happens is the investor will just sell their economic interests in the company. And what that means is this new person, all they have a right to is their share of distributions, their share of cash flow from the company. And they have no right to vote on anything. They have no right to be a full-fledged member of the company. But again, at the end of the day, very, very important that you read this provision that covers how you can get out of the company if you're an investor. And if you're a manager, what control you have as far as your investors, bringing random people into the company. So to recap, 4 provisions of the operating agreement that you should pay attention to. Number 1, management authority and management rights. Number 2, voting rights and those thresholds of what is required to pass those votes. Number 3, capital calls, whether they are mandatory or permissive, and what kinds of penalties are imposed for not contributing under a capital call. And then the last provision, liquidity. How can you get out of the deal? How can you sell your interest to a third party? And what rights do those new investors have when they buy your interests in the company? Again, end of the day, very, very important that if you're, setting up an LLC, you talk to your attorney when you're drafting your operating agreement and you make sure that it's drafted the way that you want it, and you read all these provisions and make sure that you follow them, because, this is the governing document for the LLC. If you're an investor in a deal, you need to pay attention to these provisions because this is going to control how the company is run and how your investment is run. I hope that was helpful. If you have comments, questions, maybe, you've invested in a deal yourself and you've run into issues with some of these provisions, feel free to drop a comment below. Happy to engage and answer any questions you have. Again, our website is TNLLP.com. You go there, you can sign up for a free consultation with any of the attorneys at our firm. And I will see you guys next time.
Thanks for watching. If this was helpful, give it a like and leave a comment with your questions. We read them, and they often become future videos. Subscribe so you don't miss what's next. And head to book.tnllp.com to grab a free copy of Gene's best-selling book on securities and crowdfunding. It's a whole new business.